Learning without thought is labor lost. Thought without learning is perilous. In the world of investing, one approach has captured the imagination of many, the coffee can portfolio. Originating from the simple notion of safeguarding valuable items in a coffee can, this investing method has gained considerable attention for its promise of hands-off long-term growth. But as we delve into the depths of this strategy, it's essential to unravel the truth behind the buzz and critically examine its merits and potential pitfalls. Welcome to a short journey of financial scrutiny, where we'll analyze the coffee can portfolio from a sharp critical mindset. In this introductory section, we will provide an overview of the portfolio, discuss its purpose, and highlight its importance in the world of investing. The coffee can portfolio is known for its long-term approach and limited portfolio turnover, making it an intriguing strategy for investors looking to achieve long-term compound growth, while minimizing transaction costs and maximizing tax efficiency. Now let's dive into the definition of the coffee can portfolio. This investment strategy involves carefully selecting high-quality stocks and holding onto them for an extended period, regardless of short-term market fluctuations. The term coffee can portfolio originated from a practice in the early 20th century, where investors would physically store their stock certificates in a coffee box for safekeeping. The strategy gained significant attention after Robert Kirby's article, The Coffee Can Portfolio, was published in 1984, highlighting the exceptional long-term performance of a group of stocks. When it comes to the investing strategy of the coffee can portfolio, it can be characterized by its long-term approach. Investors following this strategy are typically focused on a long-term investment horizon, spanning several years or even decades. The coffee can portfolio also employs a buy-and-hold strategy, where high-quality stocks are purchased and held for the long term, regardless of short-term market fluctuations. The strategy aims to minimize portfolio turnover, reduce transaction costs, and minimize capital gains taxes. The coffee can portfolio offers several benefits to investors. One key advantage is the reduction in transaction costs. Investors can save on expenses associated with transactions by minimizing portfolio turnover and avoiding frequent buying and selling of stocks. Another benefit is tax efficiency. The long-term holding period of the portfolio can lead to potential tax advantages, as capital gains taxes may be deferred or reduced. Finally, the coffee can portfolio aims to achieve long-term compound growth by holding onto high-quality stocks over an extended period of time, allowing the power of compounding to take effect. While the coffee can portfolio has its merits, it also faces some critiques. One criticism is the lack of active management. Critics argue that the portfolio may miss out on opportunities to adjust holdings based on changing market conditions, potentially impacting performance. Another critique is the risk of market timing. As the portfolio takes a long-term approach, there is a possibility of missing out on short-term market fluctuations that could impact returns. Additionally, the focus on a limited number of stocks in the coffee can portfolio may introduce concentration risk, as the performance of these few stocks could heavily influence overall returns. Taking a look at the historical performance of the coffee can portfolio, we can find various case studies that highlight its success in generating significant returns over the long term. These case studies provide real-world examples of the portfolio's potential, like the one conducted by Brian Hawley and published in the 2023 AAI Journal. Additionally, the historical performance of the coffee can portfolio is often compared with other investment strategies to assess its effectiveness in generating consistent, long-term growth. These comparisons help investors better understand the portfolio's unique characteristics and advantages. The coffee can portfolio also faces academic critiques. One fundamental critique is the efficient market hypothesis. This hypothesis suggests that stock prices quickly incorporate all available information, making it difficult to outperform the market through selective stock picking consistently. Another academic theory, the random walk theory, argues that stock prices follow a random pattern, making it challenging to predict future movements and achieve consistent returns. Moreover, behavioral biases like overconfidence and loss aversion can impact investment decisions, potentially affecting the performance of the Coffee-Can portfolio. These academic perspectives encourage a thoughtful examination of the portfolio's underlying principles and assumptions. To optimize the Coffee-Can portfolio, specific strategies can be employed. Diversification plays a crucial role by spreading investments across various sectors and asset classes, reducing concentration risk and enhancing long-term stability. Risk management techniques, such as setting stop-loss orders or utilizing options, can help mitigate downside risk and protect the portfolio against significant losses. Additionally, regular review and rebalancing of the portfolio ensure that the initial allocation is maintained and allow for adjustments based on changing market conditions or the investor's risk tolerance. Implementing the Coffee-Can portfolio strategy can present several challenges. One of the key challenges is identifying stocks that have the potential to deliver long-term growth and outperform the market. Additionally, managing and tracking the performance of a large portfolio over an extended period of time can be time-consuming and may require specialized tools. Finally, investors may face psychological challenges in sticking to a long-term investment strategy, particularly during periods of market volatility or when confronted with short-term performance fluctuations. Overcoming these implementation challenges is crucial to successfully executing the Coffee-Can portfolio strategy. Studying real-world examples of successful Coffee-Can portfolios can provide valuable insights and lessons for investors interested in adopting this strategy. By analyzing these portfolios' performance, investors can better understand how a long-term approach and limited portfolio turnover can contribute to sustained growth and potentially outperform the market. A well-known book that studied the Coffee-Can investing method is The Unusual Billionaires, which discusses companies with an annual return on capital of 15% or more, and where sales increased by more than 10% each year for the last decade. Learning from these examples can help investors make more informed decisions when implementing their own Coffee-Can portfolios. While the Coffee-Can portfolio has gained popularity, critically evaluating its place among other investment strategies is essential. Critics argue that the Coffee-Can portfolio is just one approach among many, and its effectiveness may vary depending on an investor's goals and risk appetite. Additionally, academics engage in a debate over the merits of active management strategies such as the Coffee-Can portfolio, as compared to passive management using index funds. It is essential to consider alternative investment strategies and weigh the potential benefits and drawbacks of different approaches before adopting the Coffee-Can portfolio method. In conclusion, the Coffee-Can portfolio offers a unique long-term investment approach that emphasizes buy-and-hold principles and limited portfolio turnover. Key takeaways include understanding the fundamentals of this strategy and thoroughly evaluating investment goals and risk tolerance. Investors should consider diversification and risk management strategies when implementing the Coffee-Can portfolio. Further research into the performance and characteristics of this strategy can help investors refine their understanding and implementation. Ultimately, the Coffee-Can portfolio can be a valuable tool for investors seeking a long-term hands-off approach to investing. It is worth to remember, investing is not a one-size-fits-all endeavor. Please, keep in mind that no approach is immune to scrutiny. The Coffee-Can portfolio, while intriguing, might not be the ultimate solution for every investor. Always do your own due diligence. There's always more to learn and discover. If you found this video insightful, don't miss out on our future ones where we dissect more financial strategies and offer insights to empower your investment decisions. So hit that subscribe button and ring the notification bell to stay tuned for more engaging content that challenges conventions and helps you navigate the intricate world of finance.